Let me ask you a brutal question. If you lose 50% of your portfolio, how much do you need to make to recover? Most people think, easy, I just need 50% back. Wrong. You need 100% just to return to zero. And I've seen this in real life. A guy started with 40,000, lost half, then made 100% in a year and ended up with the same $40,000. That's why Warren Buffett has rule number one: don't lose money. Today, I'll show you the math that keeps investors poor. If you want to understand investing on a deeper level, subscribe to the channel right now. And if you're serious about building capital step by step, there is a free investing webinar under this video in the link in the description. Now let's begin. I'm Ravi Gabis and welcome back to the Gabis Show, where we unlock the secrets of real wealth in the United States every single day. So we continue talking about investing and specifically about the rules you must follow if you want to succeed. Yesterday, we discussed two important principles: never invest your last money and never invest other people's money. Today, we continue. And this next rule might be the most important one because even Warren Buffett has only two main investment rules. Rule number one, don't lose money. Rule number two, never forget rule number one. Why is this so important? Because once you lose serious capital, recovery becomes extremely difficult. Let me give you a real example. Years ago, when I was actively trading in the stock market, I was part of an investors club. There was a guy who started with about $40,000. He began trading aggressively. In a short period of time, he lost $20,000. So 50%, half of his capital was gone. After that, he became serious. He started studying, reading, analyzing charts, doing technical analysis. He became disciplined, and in 1 year, he made 100%. That sounds impressive, right? But let's calculate. He started with $40,000. He lost 50%, which left him with $20,000. Then he made $100,000 on $20,000. So what does he have now? $40,000. He worked an entire year and ended up exactly where he started. If we consider inflation, he actually lost money. That's the brutal reality of losses. If you lose 50%, you need 100% just to recover to the same level. And making 100% consistently is extremely rare. This is why professional fund managers usually control maximum drawdown. Most of them try not to allow losses deeper than 20-25%. Why? Because recovery math becomes painful. Let's say you have $100, you lose 20%. Now you have $80. You gain 20% back, and now you have $96. You're still below your starting point. Lose 25%, you are at 75. Gain 25%, you are at 93.75. So still not recovered. The deeper loss is the harder recovery. And if you lose 50%, you need to double your money. That's why Buffett says, don't lose money. Let me give you another real story. There was a guy, he was a Forex trader. He collected around $2 million from investors. He was trading very aggressively using leverage in the commodity markets, and in just a few days, he lost 50%. $1 million disappeared. Instead of stopping, he tried to recover. Within 2 months, he lost everything. Why? Because once you're down 50%, the psychological pressure becomes enormous. People start thinking the lost money still exists somewhere, but it does not. It's gone. And you must now rebuild from a much smaller base. This is why I prefer steady returns over aggressive trading. I'm not in favor of chasing 100% gains. I'm in favor of consistent 15 to 25% per year. If you can achieve that for decades, you will become very wealthy. Slow growth with discipline beats aggressive speculation. So today's rule is simple. Protect your capital first, because once capital is damaged, recovery becomes exponentially harder. If this episode gave you clarity, subscribe. And if you want a structured roadmap for building capital the right way, watch the webinar under this video. That's, I think, enough for today. Tomorrow we'll continue with the next rule. So see you tomorrow.